Welcome to RV Academy. In my previous video, I explained what is capital gain, what are the types of capital gain, short-term capital gain and long-term capital gain, and how to compute the capital gains, what are the various deductions under section 54D to 54EF. So the list of deduction chart is given with the details in my previous video. Let me take one example and work out. Mr. Madhu purchased a plot in 2006 and 7 for 6 lakh rupee. It was sold on 15th of January 2019 for 16 lakh 80,000 and he paid 20,000 as brokerage charges. He invested 2 lakhs in NABARD bonds on 31/3/2019 and 3 lakh 10,000 in bonds issued by Rural Electrification Corporations Limited on 31/3/2019. Compute his taxable capital gain if cost of inflation index for 2006 and 7 was 122 and 2018 and 19 280. Now just look at this format here. Sale consideration, at what price it is sold? 16 lakh 80,000. He sold the property for 16 lakh 80. Take that sale consideration here. Selling expenses, he paid brokerage 20,000. Deduct brokerage. The balance is net consideration 16 lakh 60. We have to apply index cost because it is long-term capital gain. If the asset is held for more than 36 months and sold, it comes under long-term capital gain. When there is a long-term capital gain, we have to apply the indexing. So 6 lakhs into 280 for the previous year. Index for the previous year is 280 and acquired in the year 2006 and 7. During 2006 and 7, index was 122. 280 by 122 becomes equivalent to 13,77,049 today. So if you minus, you get LTCG, long-term capital gain, 2,82,951. So exemptions under section 54 is a actual investment 3,10,000 and capital gains 2,82,951. Whichever is less. So whichever is less, the capital gain 2,82,951 is less. So I have taken 2,82,951. The taxable LTCG becomes 0, nil. There is no any capital gain in this particular case. Let me take one more problem. Mr. Vinay, resident, purchased a residential house in Bangalore on 1499 for rupees 50,000 and added first floor in 2000 at a cost of 10,000. On 1st of December 2011, he gifted the house to his son Mr. Vinod, who added 2 rooms in June 2014 at a cost of 1,50,000. On 1st of November 2017, Mr. Vinod sold the property for 20 lakhs. Find out the taxable capital gain of if the FMV, that is fair market value of the property, as on 1/4/2002 is 5 lakhs. Here we have to see 3 important things. The first thing is Vinod is received the property as a gift from his father Mr. Vinay. First point, when it is received as a gift, the cost for the previous owner will be taken as a cost for the assessee also. That is the first point. The second point, here the property is purchased by Mr. Vinay in the year 99 before the development of index cost. The index cost is developed since from 2001-2. So before that, if any asset is acquired, we are going to take 2 points. One is fair market value or the cost of acquiring the asset, whichever is higher. Fair market value, cost of acquiring the asset, cost of acquisition, whichever is higher will be taken into consideration. So now, just look at this problem. Sale consideration 20 lakhs. He sold for 20 lakhs. Minus selling expenses, there is no any selling expenses given, so nil. The net consideration becomes 20 lakhs. Index cost of acquisition, actual cost is 50,000, fair market value is 5 lakhs. Among these two, whichever is higher will be taken as actual cost. That is 5 lakhs. 5 lakhs into 280. 280 divided by 184. Always the previous year index should be multiplied and the date of acquisition will be divided. So previous year index is 280 divided by 184. So 280 by 184 we get 7,60,870. Index cost of improvement. So he improved the property. So 1,50,000 into 280 by 240. 280 by 240, it comes to 1,75,000. So total amount comes to 9,35,870. If you deduct, the balance will be LTCG, long term capital gain. There is no any deductions allowed because he is not either invested in any other assets or invested in NABARD bonds or something else. So there is no deductions, nil. Taxable LTCJ becomes 10,64,130. These are the two examples for LTCG. Now I will work out one problem on STCG. Just look at this problem. Mr. Anish sold some of his properties during the year 1/4/2018 to 31/3/2019. He is as under. Jewellery costing 1,60,000 was sold for 3 lakhs in May 2018, which as acquired in 2015. Residential house at Bangalore, which was inherited by him in 1994. Sale price on 31/10/2018, 17 lakhs. Fair market value on 1/4/2001, 8,28,000. Cost of improvement made during the year 11/12, 1,92,000. Expenses on transfer 50,000. Household furniture costing 28,000 in 2012-13 was sold in March 2019 for 52,000. Machinery, WDV of machinery 76,000 and was sold on 1/12/2018 for 90,000. Self-cultivated land was compulsorily acquired under law for 8 lakhs on 1/1/2019 and its cost in 2004-05 was 4,80,000. Compute is taxable total capital gain if CII, cost of inflation index, for 2001 is 100, 2004-05 113, 2011-12 184, 2018-19 218. Now just look at the problem here. If asset is held for more than 36 months, then it comes under LTCG. If asset is held for less than 36 months, it comes under STCG. So jewellery, first let me say jewellery here. Jewellery costing 1,60,000 was sold for 3 lakhs in May 2018, which as acquired in 2015. 15, 16, 16, 17, 17, 18. So that means it is less than. You just calculate, it comes less than 36 months. May 18, June 15, June 15 to July, June 15 to May 16, like 15, 16, 16, 17, 17, 18. So that means it is less than 36 months. So it comes under STCG. I have written here STCG. Similarly, residential house in Bangalore, which was inherited by him in 1994, sale price on 31/10 to, that means it is comes under LTCG. Residential house comes under LTCG. Household furniture, any household furniture is exempted, it is not to be taxed. Then machinery, WDV of the machinery is 76,000 and was sold on 1/12/2018 for 90,000. When WDV is given, it comes under STCG. Self-cultivated land was compulsorily acquired under land law for 8 lakhs on 1/1/19 and the cost in 2004-05 is 4,80,000. So self-cultivated land comes under STCG. So two assets are given under STCG, two assets are given under LTCG. First let me explain the STCG. Sale consideration 3 lakh rupees, jewellery sold for 3 lakhs, machinery is sold for 90,000. Selling expenses, there is no any selling expenses for both the assets. The net consideration becomes 3 lakhs and 90,000. Cost of acquisition, here we don't apply the index cost when it is a short term capital gain. So 1 lakh 60 and 76,000. Taxable STCG is 1 lakh 40 and 14,000. The two assets, jewellery and machinery, comes under STCG. Jewellery is held for less than 36 months. Machinery, the WDV of the machinery is given so that it should be assessed under the STCG. Computation of LTCG of Mr. Anish for the assessment year, residential house, self-cultivated land. Sale consideration 17 lakhs and 8 lakhs. Selling expenses only for residential house is given 50,000, deduct 50,000 nil. Net consideration becomes 16 lakh 50 and 8 lakhs. Index cost of acquisition 8 lakh 28,000. You just look at here, the asset is acquired in the year 1994 and the fair market value is 8 lakh 28,000 in the year 2001. So fair market value or actual cost of acquisition, whichever is higher. So here cost of acquisition is not given but fair market value is given. So 8 lakh 28,000 into 280 by 100 comes to 23 lakh 18,400. Further, there is a improvement made during the year 11-12 for 1 lakh 92,000. 1 lakh 92,000 into 280. Always we have to multiply the previous year indexing divided by the date of improvement, that is 184 in the year 2000. So 280 by 184, 2 lakh 92,174. When you add up these two, it comes to 26 lakh 10,574. Similarly, self-cultivated land. Self-cultivated land was compulsorily acquired under law for 8 lakhs on 1/1/2019 and its cost in 2004-5 was 4 lakh 80. 4 lakh 80 into 280 divided by 184 since the index cost is 184 in the year 2004 and 5. The amount comes to 11 lakh 89,381. When you minus, there is a loss here, long-term capital loss. It is called to be the long-term capital loss. And furniture, here the household furniture does not comes under the capital gains at all. Please like, share and subscribe my video. Thank you.